Hello! Welcome to the Enron 2 episode of Slate Money, your guide to the business and finance news of the week, in which the guy who was in charge of dealing with bankrupt Enron then became the guy who is now in charge of dealing with bankrupt FTX. His letter came out this week, and I am going to talk about it. I am Felix Salmon of Axios. I'm going to talk about it with Elizabeth Spiers.
Hello.
And also Emily Peck of Axios.
Hello.
We're going to talk about all of the other parallels, Lehman Brothers, WeWork, Uber, I don't know, Theranos, lots of parallels in terms of business history of businesses going bust and trying to wonder, like, what were the implications of that and what could the implications of the FTX collapse be? We are going to talk about Joan Didion and her estate sale. We have a Slate Plus on Elon Musk and the way he's tweeting all of his CEO decisions. Is that a good idea? Find out on Slate Money.
Slate Money is brought to you by Progressive. Are you thinking more about how to tighten up your budget these days? Drivers who save by switching to Progressive save over $700 on average, and customers can qualify for an average of 6 discounts when they sign up. A little off your rate each month goes a long way. Get a quote today at Progressive.com. Progressive Casualty Insurance Company and Affiliates. National annual average insurance savings by new customers surveyed who save with Progressive between June 2020 and May 2021. Potential savings will vary. Discounts vary and are not available in all states and situations. Hey there, Slate Money listeners. Before we start the show, I want to let you know about a story coming up a little later. It's from one of our sponsors, Charles Schwab. Schwab's passion for serving clients is inspired directly by the values of the people who work there. It's what sets them apart. Stick around to hear how Jim's approach as a Schwab financial consultant was shaped by values instilled by his father.
Okay, so for the second week running, we have to talk about FTX and SBF because there has been so much more news than we had last week. And I guess the place where we should start is probably the first day motion in bankruptcy court in Delaware, which didn't get filed on the first day like it normally does. It took about a week for John Ray, who's the new CEO of FTX, to even file the motion saying, like, this is why we're bust. And the TLDR is basically because it was a complete shit show. There was no accounting. There was no record keeping. Money just disappeared. No one knows where the money is. And, you know, this is the guy who was in charge of Enron. And he's like, Enron doesn't even come close to how much of a shit show FTX is.
Right. He said, never in my career have I seen such a complete failure of corporate controls. Devastating.
Yeah, I don't think I fully internalized how bad it was until I saw the quote unquote balance sheet that the FT published from SBF. That is not a balance sheet. It's something, but
it was an Excel spreadsheet with some numbers scribbled on it and a couple of like notes to self. And yeah, and that was what he was going out to potential rescuers with, saying, hey, you know, we have $8 billion worth of magic beans, so can you lend against them? And everyone was like, no, we can't. And where's the actual money that people put in? But then the other thing we should mention was this absolutely wild interview that SBF gave to Kelsey Piper of Fox, where he was like, yeah, basically we kind of didn't have a bank account for FTX. So people would wire money to our hedge fund, and then we never really kept track of it. And then the money just kind of disappeared and, I don't know, shrug. You know, you're like, what?
He was basically like the customer deposits were just in this big pile of money and we didn't segregate them and we don't know what was what. And some of it went to Alameda and who knows? Yeah.
What we did learn is that $1 billion that Sam Bankman-Fried, you know, the guy who's like, I can live on $60,000 a year and my job is to just give away all of my wealth, that he took a personal $1 billion loan from Alameda.
That's just astonishing.
I guess my question is now, as all of this becomes untangled, is how much of this was sloppy incompetence? Because it does seem clear that there was sloppy incompetence happening. That's
There
what John
was
Ray has
a
said.
level of sloppy incompetence that was unprecedented in, multi-billion-dollar companies. I think we can say relatively safely that never has a multi-billion-dollar company been run this sort of sloppily and incompetently. Partly because most multi-billion-dollar companies get that way by growing and evolving and developing layers of management and stuff. And FTX just never did that.
Right. And so we know that there was incompetence and sloppiness, but then the other question is how much was self-dealing, fraud? How nefarious was this? That's the question I have.
Well, when you're dealing with other people's money, which is what they were doing, other people were exchanging on FTX, other people were, investing money in FTX equity and all of that kind of stuff, then sloppiness is fraud. The sloppiness is the fraud. I guess you can ask, to what degree was it malign intent and to what degree was it just like, oh shit, we thought we were on top of it and we turned out not to be. But they didn't even really think they were on top of it. And, as Matt Levine pointed out in his column, on one level, apparently there were only 4 or 5 people who knew about the secret transfers between FTX and Alameda. But on another level, everyone who worked there knew how just batshit it was, how there was no HR department, no real accounting department, how expenses would be approved by emoji and that kind of thing.
No board oversight, apparently.
Well, there was no board.
There was an interview with, or it wasn't an interview, it was a profile on Sequoia's site with SBF in the early days of their funding that was just completely, fawning. And the person who wrote it just talked about SBF having this kind of magic aura that everybody wanted to be around. And they took the piece down because in retrospect, it looks awful. But when you consider that that's a big part of how the thing got funded in the first place is just, funding entrepreneurs off of vibes, it's not totally surprising that, he ended up where he ended up, I think.
Well, I mean, let's be clear about this. That piece was published in September. It wasn't published a long time ago. It was published pretty recently. And Sequoia, were funding a very fast growing company, which was making, 40% profit margins on 100% growth on $250 million of revenue or whatever. There was real money in there. And there was, the business model made sense. Now, obviously, they didn't require audited income statements and balance sheets because there were no audited income statements and balance sheets. And obviously, with hindsight, they should have done. But what they thought was that they were funding a genuine normal business. And I think on some level, they just kind of assumed that because he had so much respect on Capitol Hill, because he had all of these, as you say, fawning coverage in the press and all the rest of it, that he wouldn't just
steal money from people and use it to invest in other stuff.
Right, exactly.
That is what we're talking about, to be clear.
I think the idea that it was a complete fraud probably just didn't occur to them because he felt, and this is something that he went on to say in that amazing Vox interview, was that the way that he persuaded people that he wasn't a complete fraud was by using a shibboleth. And I love this word. It's one of my favorite words. And a shibboleth is basically a word which basically shows that you're part of the in crowd. And if you pick your shibboleths correctly, then people will trust you. And the shibboleth that he used was this thing called effective altruism. And he talked so much about effective altruism that people trusted him because he used the right words. And then he came out to Vox and said, yeah, I didn't actually necessarily believe in any of it, but it was a great way of getting people to trust me.
Did people trust him because of his stance on philanthropy, or did they trust him because it looked like this company was making tons of money? People, you cannot discount people's willingness to fall for someone who says or is a billionaire. And engender that person with sort of trust or a belief that they're a genius or whatever. As soon as you cross that billionaire line, you've suddenly gotten yourself credibility.
Right. And one of the interesting things about SBF is that he was that rare, entrepreneurial Silicon Valley billionaire type who was making tons of money, at least ostensibly, according to the accounts that he was showing Sequoia. If you look at most high-flying Silicon Valley billionaire types, whether it's, Adam Newman or Travis Kalanick or Elon Musk, the way they become billionaires is by losing lots of money, right? And they're like, we need lots of funding, give us funding at ever increasing valuations. I own a percentage of the company, so I'm a billionaire on paper. My company is losing money, but we are investing it all in payroll and growth and blah, blah, blah. And then the company will be worth lots of money in the future. So FTX was a weird outlier in that respect, in that SBF was coming out and basically saying, I'm already profitable. And I'm making billions of dollars on my own without you. And do you want in on this? I guess no one stopped to ask, well, why do you need the money then?
Because he's stealing it. I mean, to be sure.
I think he also went to great lengths to kind of brand himself as somebody who wasn't a materialist. He said he could live on $60K a year. He was sleeping on a beanbag in the office.
He was sleeping on a beanbag in his $40 million Bahamian apartment. I mean, this is the other thing. He had a massive portfolio of Bahamas real estate, we are pretty sure. As I say, he also borrowed personally $1 billion from Alameda Research, his hedge fund. Now, that's $1 billion that he didn't spend on yachts. It was $1 billion that he spent on, venture investments and that kind of stuff. But still, he was living a very glamorous life. It's a bit unclear whether he was flying commercial or private. I haven't quite been able to get to the bottom of that one, but he was certainly palling around on stage with Tony Blair and Bill Clinton. And, he was certainly getting the kind of respect from the world, the magazine covers, the conferences, and all the rest of it. That were the kind of things that he would buy if those things were things you could buy.
Yeah, and to go back to the effective altruism point, that was a little bit of a cover for anything that he wanted to do that seemed a little bonkers. He could sort of frame it as long-termism. Or maybe we should explain what effective altruism is.
Yeah, I'm not sure about that. I mean, maybe. So, okay, so we've talked a little bit about this on the podcast before, and I'm sure we will again, but broadly, the idea behind effective altruism is the idea that you can go out and make the world a better place by, say, going to medical school and becoming a doctor and learning how to save people's lives and then jetting off to Uganda and saving people's lives. And you'll be like, great, I have saved lives. That's me being, behaving ethically. Or alternatively, you could do good in the world by, going to business school, going to a hedge fund, making $1 billion, and then giving that $1 billion to an organization which can save lives at a rate of $5,000 a life. And then, boom, you've saved, 20,000 lives rather than one life. And so that's 20,000 times better to do that.
And this seems like a very self-serving rationale for hoarding absurd amounts of wealth.
Well, no, it's a rationale for giving away lots of wealth. It's certainly not a rationale for hoarding it, right? There's nothing in the EA which says you should hoard anything.
Yeah, but you have to accumulate it.
It's a rationale for earning and accumulating an unreasonable.
So there's earn to get
amount of money, probably.
So there's two different ways of looking at this, right? One is, you work for Jane Street Capital, which is this big hedge fund that SBF used to work for, and they pay you lots of money because you make lots of money at your job. And then what you do is you just give away that money as soon as you make it, and you're living on your $60,000 a year or whatever it is. There is nothing in the EA which says you should hoard or retain any of that money. The alternative is that rather than maximizing your income, you try and maximize your wealth accumulation. And so what you do then is you start investing money in something like, I'm starting a company called FTX, or I'm going to sponsor sports arena in Miami because somehow that's going to be plus EV, plus expected value. And the amount of money I get back from sponsoring that arena is going to be greater than the amount I spend on sponsoring the arena. So then in the long term, that's going to be better for saving lives down the road. And that's where EA gets a little bit dubious, because at that point you're making a trade-off. You're like, do I spend this money now on saving lives, or do I hold on to it and try and invest it and make it even bigger and then use that bigger amount to save lives? And the way that SBF thought about this, which was very explicit, and he said this in interview after interview, was basically, if I have like positive expected value to my investments, I should always, because he has this linear utility function, which we won't go into, but I will always take that bet, even if the investments only have like a 1% chance of paying off. So if I have a 99% chance of going to zero, but I have a 1% chance of making $5 trillion, I will take that 1% chance. And so 99% of the time I will go to zero. But in the grand scheme of things, I am making money in some kind of, like, if I look at all of the 100 possible universes that I'm in or something, it all becomes very weird and theoretical. And I think, honestly, he has wound up basically doing possibly mortal damage to the entire EA program, because like people realize now that it just winds up in these absurd outcomes.
Is that a bad thing? I mean, when I hear about effective altruism, and I think this is the second time, or honestly the third time, Felix, that you've had to explain it to me, I think this is dumb. People should do good in the world themselves. They shouldn't excuse doing bad, which often is what they wind up doing to accumulate billions of dollars.
No,
by
I mean,
saying
so
that
to
down
be very
the road they're going to give it all away.
but that's a little bit of a straw man, right? So the EA crowd has always been very clear that this is not some kind of utilitarian ends justify the means thing.
But
right?
it is.
But no one never made that argument.
But the argument is make a lot of money so you can give it away. And making a
Right.
lot of money is typically involves not really doing much good at all. In fact, often doing not good. So yeah, the ends justify the means. That's baked into that strategy. I don't see how it's not.
In terms of isolated decision making, it is ends justify the means a lot of times, because the other premise of EA is that you can actually evaluate what matters long term versus short term costs. So if a few people die right now, it's fine if you're saving lives over the course of the next 100 years. And there's a kind of arrogance to that, I think, and there's a reason why it appeals to a lot of neo-reactionary types in Silicon Valley, because it presumes that you can have a class of elites who can determine all of these things and really evaluate on a top-down basis what's worth it and what isn't.
It's kind of like how they manage their businesses by saying it's all about the future. Like, yeah, I'm not making money now, but I will be someday. Like, yeah, we're not changing the world now, but we will someday. Like, yeah, what we're doing now is important someday. It's like, just get in the now, guys.
So there's a few different things to unpack here. The first thing is that long-termism and effective altruism are two different things. Like, long-termism is one flavor of effective altruism. There are other flavors of effective altruism which are not long-termist and are much more short-termist, and saying like, we just want to save the maximal number of lives that we can today. And an outfit like GiveWell would be a good example of that. And they do not do that kind of thing where they're like, it's okay if, if we fail to save a life today, so long as we do manage to save 3 lives tomorrow. They generally reject that kind of thinking. So I think the damage to long-termism is greater than the damage to EA more generally here. So that's the first thing. The second thing, Emily, I think is just that if you come at EA with if you come at this whole concept with the idea that making money is intrinsically harmful, and that you need to sort of make up for that intrinsic harm by then giving it away, you are not going to adopt it. Like, I think everyone who does this earn to give kind of strategy on some level, it has managed to convince themselves that the way they're making money is not intrinsically harmful and might
Right.
actually be a good thing.
Right.
So I don't think you have people out there in the world who are saying, well, what I'm doing is bad, but I will make up for it by doing good things with the money that I earn. I think what you have is people out there in the world saying, what I'm doing is good. And, my wonderful crypto utopia where everyone winds up dealing in cryptocurrency is ultimately going to be a good thing. And then on top of that good thing, I'm also going to take the money I make and make the world a better place that way too. And it's like a win-win.
Right. I guess that's what bigger picture kind of bothers me. It's like these guys that run these companies or found these companies talk about their philanthropy and like their side gigs doing good. But when you have a big company and you have employees and investors and backers, like your first priority should be doing the ethical and right thing with that business. You know what I mean?
Absolutely.
And
Absolutely. And this is something that SBF has come out on Twitter a lot and said. It's like, my first priority is to my customers. My first priority is to get my customers their money back. But the fact is that the way that he was running the business and the way that he was taking enormous risks with his customers' money while he was running the business and the way that he grew by taking these huge risks was clear evidence that he didn't really believe that, and that he, and that like there was some other thing that he was maximizing beyond like the safety of his customers.
right. And to be clear, like I don't think like founding and running a company is like doing harm in the world. Like it could be a very good thing to invent something new, change people's lives, employ a lot of people, create jobs. That's all good stuff. Like, I guess I object to the use of altruism, philanthropy, whatever, as PR for yourself. I guess I'm just repeating
Right,
myself.
and that's what
Do
he was
good
talking about
at
the
home first.
shibboleth.
Yeah.
Exactly.
There's also a kind of line of rhetoric in tech that doesn't really exist in other industries where everything you're doing ostensibly you're doing to make the world a better place or save the world or whatever. You never hear that coming from somebody who starts a private equity fund or somebody in a different industry.
You would be surprised, actually. I mean, like seriously,
I've never heard it.
No, well,
Listen
grab
to Anna Shemansky from Old
Yeah.
Slate Money. She's
exactly, or
all the
listen
time.
to Sebastian Mallaby, who just has a whole just released a whole book basically talking about how like the entire wealth of the planet and the reason why we're so better so well off is because of the amazing genius of Silicon Valley and venture capital. Like these arguments do get made on a regular basis.
Yeah, about tech and VC. I just don't. I can't think of another industry where people use that rhetoric as often as they do, and about literally every single product they develop.
But I mean, but there's a case to be made, right? That no matter how much money Larry Page and Sergey Brin give away, that their impact on the world is always going to be like the fact that they created Google, and creating
Yes.
Google has made the world a measurably better place.
Yes.
In many ways.
Yeah. I'm not saying that I don't think that tech companies can change the world for the positive. I'm saying that, the rhetoric sort of goes from things like Google to your casual gaming app that you spend, on the subway playing. There's it's so broad that it's almost meaningless now.
But no, I think to your point, like we part of the techlash has been to put Silicon Valley a little bit on the back foot, a little bit on the defensive, right? And it's no coincidence, I think, that you see this uptick in highly visible philanthropy from Silicon Valley, whether it's from someone like Dustin Moskovitz, someone like SBF, or even someone like Vitalik Buterin who started Ethereum, even CZ, the founder of Binance, has said he's going to give away 99% of his wealth, right? Like they all say it, and they say it, I think, precisely because there is this tech clash, and people don't believe that technology makes the world is necessarily something that makes the world a better place.
Yeah. Also, wealthy business people have been using philanthropy to launder sketchy business practices for centuries. You read all the Chernow books about J.P. Morgan and Andrew Carnegie. I mean, this is not a
Yeah, I mean
new...
that's interesting, right? Because it tends to be sequential. Like you start off as a robber baron and then you become a philanthropist.
Yeah.
Or you start off with like inventing dynamite and then you create the Nobel Prize. So whereas these ones, it's more simultaneous.
Maybe they're just more forward looking. They know it's coming. So
Slate Money is supported by First Republic Bank, which, full disclosure, is my bank. Have you ever experienced the kind of relationship with a banker who was available to answer all of your questions, even by phone or email? Doesn't exist, you say? It does at First Republic. With First Republic, everyone gets a personal banker, a consistent point of contact who's ready to sit down and answer your questions no matter how complex. Plus, when you visit in person, First Republic will serve you cookies. To see the difference extraordinary service can make, visit firstrepublic.com. That's firstrepublic.com. Member FDIC, equal housing lender.
Support for this podcast comes from Wise, the universal account that lets you send, spend, and receive money internationally. With one account for over 50 currencies, who exactly is Wise made for? It's made for Austrians uprooting to Australia, Swedes safaring in South Africa. It's made for business in Tokyo and pleasure in Miami. Wise is made for people without borders. People who believe that using your money should be easy, even if life gets complicated. You see, with Wise, you always get the mid-market exchange rate with no markups and no hidden fees, helping you save on currency conversion wherever your money takes you. Wise. It's the account that's made for the world. Join 13 million customers and learn how the Wise account could work for you at wise.com/slatemoney.
This podcast is brought to you by Slate Studios and Charles Schwab. The people at Charles Schwab go the extra mile to help clients on their investment journey. It's part of who they are. Jim is a Schwab financial consultant. His dad was a contractor who prided himself on providing great work at a fair price.
You know, I can remember installing windows with my dad and would have to go order the windows from the distributor. And we could have bought cheaper windows. He's like, no, I don't want to buy those. If I put those in, winter's going to come. They're going to be cold. My dad instilled in me, be proud of offering a good quality product at a fair price.
Jim brings this integrity to how he serves his clients each and every day.
I know from 20 years of doing this that if you just help people and give them the guidance that they're looking for, it'll work out in the long run. They don't have to buy anything from you today. They don't have to pay you any money or commissions today. People are looking for good, honest, quality, intelligent service. I always put the people before the money. Always.
At Charles Schwab, they're not just financial people. They're people too. With 24/7 support and one-on-one guidance from financial consultants, Schwab offers the tools to help you pursue your financial goals. Learn more about what sets Schwab apart at schwab.com/whyschwab.
But we should talk about the broader context here of, corporate scandals and collapses, because Emily, we've been talking about this quite a lot. There's been so many parallels.
Yes.
And what we have seen in previous collapses has been significant consequences. When Enron collapsed, we ended up with like Sarbanes-Oxley and a massive change to the way that public companies worked.
Yes.
When Lehman Brothers collapsed, we ended up with Dodd-Frank and a massive change to the way that global financial regulation worked, and and Basel III, which I still to this day maintain is by far the most important consequence of the financial crisis. In this case, there's a very interesting piece in the FT this week, basically saying like the best thing we can do in the light of the FTX collapse is let crypto crash and burn. Like, let it burn down to the ground and go to zero. Because if you regulate it, that's just going to make people trust it more. And trusting crypto is just inherently a really bad idea.
Oh, interesting. Yeah, I've been waiting to see, it seems like there are two kinds of corporate or financial collapses. There's like ones that change the laws, like the ones you mentioned, Felix, Lehman, Enron. Sometimes they also change the culture. I think both of those count for that too. And now with FTX, it seems like it's going to change the culture around crypto, maybe. Not for the diehards and the true believers, but for the people that kind of went crazy with it for a time. And then the follow-on question is, does it change the regulation piece? And I hadn't heard that's an interesting argument. Don't regulate it, let it just fall apart. Because it was walled off enough that you don't need to. You don't.
Exactly.
No government needs to do a bailout.
There's no real systemic effects. This is the most
So far.
interesting thing to the collapse of FTX, right? Is that obviously the equity investors in FTX, they're like venture funds. They often lose all of the money they invest in a company. If they lose all the money they invest in FTX, it's kind of no harm, no foul. The biggest one was Sequoia. They're like, yeah, that fund that invested in FTX, it's still up a gazillion %. So like, we don't care. So those guys are fine. And then you have the people who had money on the FTX exchange and who lost money. And on some level, yeah, they were crypto speculators almost by definition. You don't trade on FTX unless you're a crypto speculator. Very few of them were anything other than that. And they lose their money and they learn their lesson, and some of them retreat out of crypto with their tails between their legs, and crypto generally is down. And like, this is a good opportunity to just let people realize how a completely unregulated parallel financial structure is broadly a very bad idea where people can lose their money. And coming in and trying to regulate it is just going to make people think, well, now it's regulated, they can have more confidence in it.
Don't you think, though, there's going to be some policy demand for regulation now that, these stories are sort of becoming more mainstream and people understand what's happening? Just because we're talking about retail investors.
But I feel like we're not. I feel like the number of retail investors in FTX is tiny.
That's what I was thinking. Like in the case of Enron, that company had 20,000 employees. They all lost their jobs. So did everyone at the accounting firm associated with that scandal, Arthur Andersen. All these people lost their jobs, and a lot of them lost their entire retirement savings, and they were all over the media. With Lehman Brothers, I mean, we all saw the pictures of the people leaving the offices with their boxes and whatnot. Also at the same time, like the whole economy collapsed and a lot of people lost their homes, and it was very visible. And the pain for regular people was just, it was tangible and visible and widely publicized. And so far with this scandal, that is the element I really have yet to see. I mean, it's possible it's happening and I'm not seeing it, but
I think it's too new. Like, I think, and particularly if there's a contagion effect through the rest of the ecosystem, I feel like those stories are going to come out.
But like when Helium, or Celsius, one of these other crypto businesses went under recently, it was like a lawsuit. There was a filing, and a lot of people were quoted in there saying, I lost my savings, this, that. But it didn't get the kind of attention I'm talking about with these other financial collapses, and I think that's a big difference.
So the really big thing here is that if you lose money that you have put at risk, that's fine. If you lose money that you consider to be safe, then that's not fine.
Yeah.
The thing that we consider to be safe is like my paycheck, right? I go into work every day at Enron, and then one day I'm fired. And what's more, Enron forced me to put my entire 401k into Enron stock. And so I've lost not only my paycheck, but also my 401k. And that's terrible. And then on top of that, there are these massive liabilities. So like, people across California wound up paying thousands of extra dollars for energy because Enron was manipulating the energy market in California. And that's real harm done to real people with real money that they couldn't afford to lose.
Yeah.
What we saw in Celsius was just a little baby hint of some people who were putting, dollars into Celsius, and Celsius was promising a dollar return. Now, like, we'll give you 15% return on your dollars. And they were going, oh, great, okay. And then it all evaporated, and they said, that's bad, and I've lost my life savings. But there were relatively few people who thought that crypto was a great way to just make interest on dollars, right? The reason why people get into crypto is because they want to get rich by buying coins that go up in value. That is, by definition, risk capital. We have seen Bitcoin and Ether and all the rest of them go up a lot and go down a lot. We know they're risky. Everyone who buys them knows that they're taking a risk. That is not like your life savings. That is not your reliable
House.
paycheck that you're putting at risk. It's certainly not your house. Exactly. There's no sort of bait and switch in terms of we told you this was risk free and safe, and then it turned out to be, a house of cards. A little bit of that with Celsius, but certainly not with FTX, which always, or generally the crypto ads that we saw at the Super Bowl, with Matt Damon saying like fortune favors the bold or whatever, right? Like the idea was go out and take risks, right? That was always the idea. And so long as people are going out and taking risks, the harm of those risks failing is much lower.
So I made a list of other questions to ask so you can determine if your financial collapse has legs or not.
I love it.
And the one was, of course, does the scandal affect real people? Then does the scandal come right before a recession? Then that's good. Your scandal has legs if there's a recession linked to it. Does the scandal lead to books? That's a regular scandal. Everyone writes a book about everything now. So that doesn't really count. But does the scandal lead to a movie? That's a systemic scandal, probably, especially if it's, a big hit movie. If you've got, I don't know who
Brad
the
Pitt.
star would be. Maybe a Brad Pitt. Yeah. And is there at least one colorful character that people know about as a household name? Then you've got something with legs as well. Is SBF that colorful character? I'm not sure. I asked some normal friends of mine and no one knew who he was.
Michael Lewis has been embedded with SBF for 6
Yes.
months. I feel like that alone.
And he's selling
Yes.
the movie, right? So there's going to be a movie.
Yes, but not every Michael Lewis character becomes a character. Not everyone is like a Moneyball. There are the Flash Boys. I don't think anyone.
Yeah, can
knows
can
that
either
one.
of you name the CEO of IEX?
No.
You can't.
Right. So I think with FTX, we're kind of some of these questions remain unanswered. We'll have to see, to be determined if this thing, goes far.
I think also it's just impossible to disentangle FTX from the broader crypto collapse, which has been going on for many months now. And it's pretty obvious that the proximate cause of the FTX collapse was the decline in crypto values, right? Alameda started taking directional bets. They lost a lot of money that way. They also bailed out Voyager and lost a bunch of money that way. People started pulling their money out. And of course, with any kind of bank run, that's always what causes the problem. It becomes self-fulfilling. And so, yeah, I think a lot of this is not, the FTX in that sense is maybe more of a symptom of the overextension and subsequent collapse of the crypto market than it is a major cause of it.
Yes, but that can be systemic. That's Lehman. I guess
that is also Lehman to some extent. Yeah,
it's this is a symptom, and it also.
The one we haven't mentioned is LTCM, right? Which was the other big hedge fund that went bust. And that was very similar to Alameda in a way. It was taking these bets. There was a lot of leverage in there. And then the thing we learned with LTCM was number one, when push comes to shove, there is the New York Fed and they will have an emergency meeting and they will try and make sure that the financial system can withstand the ripple effects of a major part of the hedge fund part of the economy going bust, right? There is no New York Fed in crypto, and that's hurting everyone right now. But then the other thing it did is it just reminded people of, the importance of controls and risk management and all of those kind of things. And maybe FTX will do that. Maybe anyone left in crypto will be a little bit more careful. But this is one of these worlds where you make the way to maximize your success is by finding the friendliest offshore jurisdiction and taking as much risk as possible. So if you're competing against those guys, right, this is what all of the American crypto companies always complain about. They're like, we are competing with two hands tied behind our back, given all of this, U.S. regulation. Everyone else in the Bahamas or Hong Kong or Dubai is going to eat our lunch, and they do. And so it's basically impossible to have like a successful crypto exchange that is based in the United States because there is regulation here.
Well, it's funny. Binance has been making some noise about becoming a kind of pseudo-Fed for crypto. And the idea is that they have a separate fund that's used to bail out companies like FTX, which to me just sounds ludicrous. But
yeah, I mean, well, they looked at FTX for a hot minute and then gave up. I mean, the interesting thing now is Genesis, which is Barry Silbert's one of Barry Silbert's companies. There's this weird web of companies: Genesis, Digital Currency Group, GBTC, all of these kind of things. They seem to be having a lot of trouble right now. That trouble is feeding through into Gemini, which is a different company, which is run by the Winklevi, and what we're beginning to see now is real ripple effects into the United States that up until the FTX US bankruptcy seemed like it was relatively ring fenced and that if you had your money in an American crypto company, you were okay. Now it looks like a bunch of people who had their money in American crypto companies are not okay. Genesis is suspended withdrawals and that kind of stuff. And so yeah, that could be the other next big shoe to drop is like the American retail investors get hurt. Again, like these are American retail investors in crypto. These are not, normal middle class people with life savings. But that could similarly just put off, everyone off the entire asset class, which would not be a bad thing, to be clear.
Yeah. Meanwhile, though, Bitcoin prices, I think, are holding up okay. Like, I think this stuff isn't going to go away. So it probably should be more regulated in the United States, at least. And maybe ultimately this stuff doesn't go away. People keep investing in it, although not at the scale we saw over the past couple of years. And, and those global places that compete, they go under because they're not regulated and it's kind of messy.
Yeah, I just don't like the word investment here. Right. The word investment kind of means that you're taking money and you're investing it into some project that pays some kind of returns. And, the best we can hope for in that kind of world that you're sketching out there is that people take their dollars and they hand them over to Coinbase or Robinhood or Cash App or one of those places that offers crypto. And they're like, convert this into Bitcoin. And then it gets converted into Bitcoin or Ether or whatever, right? Shiba Inu coin. And then what? That's not an investment. They're just sitting on a dumb coin, right? We had a whole season of Slate Money called Slate Money Swag, where we talked about these things, wine, gold, art, cars, sneakers, that kind of thing, which people buy in the hope that they go up in value. And you're like, that's not an investment, That's just like you're speculating on collectibles, and using the investment word for that as though there's some kind of intrinsic value. I think it's dangerous.
What are your criteria for something constituting an investment? Because I think of the early days of Bitcoin and people would talk about it like that a little bit, or as a hedge against inflation, or some kind of proxy for.
Well, I mean, it's clearly not a hedge against inflation. Like the minute inflation arrives, like it falls off a cliff.
But I'm saying this is the rationale that a lot of people used. So how do you distinguish between what you describe as, something you put money into with the idea that it's going up but it's a collectible versus an investment, quad investment?
Just cash flows. Like if you're investing in something that has future cash flows associated with it, then that's an investment. You're basically buying those future cash flows. If you buy a bond, then that will pay you interest in the future in principle. If you buy a stock, there will be like dividends in the future, or at least you own something which makes money or loses money, but there are cash flows associated with it. if you buy a house, you can rent it out. These things count as investments.
But Felix, isn't there so much of finance, even setting aside crypto, that isn't investments like you're saying? That's a lot of bets and derivatives and things like that aren't really
Right.
investing in anything. So like,
but yes,
whatever.
but that's exactly my point, right? That people don't say I'm investing in derivatives, right?
Okay, fine.
Derivatives
so it's
are
semantics here.
No, but it's a very important distinction.
Is it?
Derivatives are a zero-sum game.
Mm-hmm.
If I just buy a pile of puts and calls, I will wind up losing my money over the long term because because there's no growth there. Like if the economy grows, the puts and calls don't do anything, right? It's just a zero-sum bet. I'm
Like
just
gambling.
making a zero-sum.
Gambling.
Yeah, it's like going to my local weekly poker game.
Mm-hmm.
Like money can slosh around from one person to another, but the total amount of money cannot grow.
Mm-hmm.
So that's not an investment. That's just a bet.
Okay, it's not an investment, but it could still become part of the financial system long term, which is comprised of both investments and gambling that looks sophisticated.
Well, the idea behind sophisticated gambling is that it serves a purpose, right? You know, that if you're a farmer and you're growing wheat and
Mm-hmm.
you want to hedge against the
Right.
wheat price falling,
Right.
you buy one of
Right.
those puts to make sure that you get paid off if the wheat price falls. Like the
Right.
put is useful to you. It has utility. It's just not the business you're in. The business you're in is growing wheat.
Gotcha. We've never talked about my oil contract, but that's okay. That's my gambling, I guess, or my futures.
What's your oil contract?
My futures trading. Is it my futures trading? People who get oil in the Northeast where I am, you can contract for a certain price that you agree to pay every month, and that's either a good deal or a bad deal. The price of oil could come down, and then I could look like my futures deal is bad, or the price of oil could go up, and I look like a genius. Right now, I look like a genius, by the way.
You always look like a genius to me,
yes,
Emily.
of course. But yeah, so that I realized recently I was a futures trader, not a futures trader.
Yeah, if you lock in a price today, you pay. You're basically entering into a derivatives deal.
Yeah, that's
Look
what
at
I
you,
do.
Emily Peck, derivatives dealer.
Yep. Tell your friends. This message is brought to you by Discover. Did you know you could reduce the number of unwanted calls and emails with online privacy protection, the latest innovation from Discover? Discover will help regularly remove your personal info, like your name and address, from 10 popular people search websites that could sell your data. And they'll do it for free. Activate in the Discover app. See terms and learn more at discover.com/online privacy protection.
This episode of Slate Money is brought to you by Best Buy. Whether you're searching for exciting gifts, trying to snag the hottest holiday deals, or looking for ways to simplify the giving and receiving experience, Best Buy is here to help. They have the best assortment of impactful tech gifts. They have, an air fryer if you want to help an aspiring foodie in your life, or a new phone or a camera. Or you might be on the hunt for a new smartwatch to support a friend's wellness journey. No matter what you're looking for, Best Buy is your gifting destination for everyone on your list. And Best Buy makes it easy to get your gifts how and when you need them with free next-day delivery on thousands of items, as well as same-day delivery and in-store pickup options. Shop great deals on gifts now at Best Buy. Talking of geniuses, Emily, tell us why Joan Didion is in the news this week.
I'll try. The Joan Didion estate sale, Felix, is why Joan Didion is in the news this week. Her stuff was sold at really high prices. 2 sets of blank notebooks sold for $11,000 each. Her sunglass collection went for $27,000.
No, that was just one pair of sunglasses.
Oh, you're right. I'm sorry. One pair of sunglasses went for $27,000. It was this sort of beautifully curated estate sale that a lot of people were paying attention to.
Explain to me, Elizabeth, why people would pay $7,000 for a bunch of shells and stones from the beach just because those shells and stones from the beach happen to belong to Joan Didion. And also tell me, what are you going to do with those shells and stones from the beach once you've bought them?
Yeah, this is just pure sentimentality. This is people putting a value on a writer who I think throughout her life was deemed, the sort of essence of cool and has an incredible body of work. So I don't think anybody's buying these things with the idea that they're going to appreciate or that they even need to be, preserved for history. I think the kind of people who can afford to buy the shells and the pebbles for $10,000 are the people who are going to display it in their home somewhere and show it to people. And a lot of them are probably aspiring writers or publishing adjacent. I don't think that it's a kind of normal estate sale. It's really built around her legacy and the extent to which people feel strongly about her.
Yeah. It's kind of like in Succession when one of the brothers buys Napoleon's penis.
Right. And so yeah, but this is it. This is clearly a consumption good, right? And we're coming to that time of the year when I'm going to be flying down to Miami and going to Art Basel Miami and appearing on a panel. And one of the things that we're going to talk about is art. Is it a consumption good or is it an investment? And it can be both. And we talked about this on the show with Julia Halperin, and we kind of came up with a dividing line of $500,000. It's like below $500,000, it's a consumption good, and above $500,000, then it starts to become an investment, or at least something that you can expect to hold its value and that will go up or down in value, but you can always expect to resell somewhere. In the case of Joan Didion, like everything that sold for significantly less than that $500,000 range. So this is very much in the consumption good. No one, I think you're absolutely right. And no one was buying those notebooks thinking, I'll be able to flip these notebooks to a future Joan Didion stand. And I think actually a lot of people really, felt a bunch of tailwind just in the knowledge that the money would end up going to Joan Didion's favorite charities. It was a charitable donation on some level.
Meanwhile, when we were reading stories for this segment, I was reminded of the Elizabeth Wurtzel estate sale, which also happened recently. Elizabeth Wurtzel's like a Gen X writer. She wrote, what's the book? Prozac Nation, right?
Yeah.
In the 90s, it was a big bestseller. But then after that, she wasn't as successful as Joan Didion. And Corey Sika at New York Magazine went to her estate sale or watched the estate sale. And it was like the exact opposite of the Joan Didion estate sale. Things went for very little money. Her notebooks and pens and pencils was like $29 or something like that. Couldn't be more different. And I was thinking it's just sort of a signifier of how writers of Joan Didion's era and generation were perceived versus like our generation of writers.
I feel like it's actually much more a function of like who your executors are, right? Joan Didion was part of this very grand family with, various different duns floating around, and they did a very good job, as you say, of curating it, taking it to a relatively respectable auction house in Hudson, New York, getting a bunch of press around it, making it cool, making it notable. Whereas Elizabeth Wurtzel, she was maybe kind of divorced. No one was entirely clear. She was kind of estranged from most of her family. No one was there kind of saying, like, we can make a thing out of this. And there was just a bunch of random bits and pieces that needed to get sold off, and they just wound up getting liquidated. And a lot of it is marketing, frankly.
Yeah, that's the point. It's all about marketing, how much money any of this stuff gets and the way it looks at the day of the sale.
And you just need to build up the hype, as Taylor Swift will tell you. Just make sure that you get everyone wanting to buy the same thing at the same time, and you can sell 2 million tickets in an hour.
That's incredibly Gen X then for Elizabeth Wurtzel, that she didn't, that her death wasn't commercialized and her estate sale wasn't commercialized. It's like, it's sticking the finger to the man. I don't know.
Yeah,
I'm
I think some of
grasping.
her people around her were kind of pissed off that it wasn't advertised, because I think there were people who, knew her, who wanted to pick up some of her stuff, and they
Yeah.
didn't know about it, which is kind of sad.
That is
Hello,
sad. Sometimes
Emily?
marketing is a good thing, right?
Emily, do you want your death to be commercialized? Is that how you would like to go?
Yeah. I want my snow globe collection to be displayed prominently and tastefully and fetch many hundreds of dollars.
Just think, this isn't just any old snow globe collection. It's Emily R. Peck's snow globe collection, and that has to be worth something. Let's have a numbers round. Elizabeth, do you have a number this week?
20%, and that's the amount. The amount by which home sales in Florida have gone down if you're looking at coastal estates where the land is less than 6 foot above sea level. And this sort of points to people, being climate refugees and deciding that particularly they're not going to retire down there in places where those houses might be affected by climate. But Florida housing generally has gone up. So this is the one trend that sort of points to climate change as a driver for real estate shifts.
Yeah, and I think you can't get insurance on those houses too.
Yeah, exactly. Getting insurance is almost impossible. My number is also a price change number, but this one is positive. It's plus 23%, which is the amount that New York City taxi fares are going up. If you hail a yellow cab in New York City, thanks to the Taxi and Limousine Commission, the fare you pay will now be 23% more than it was, a week ago. This sounds like terrible inflation, but it turns out that this is the first fare hike in a decade, and I think that over the course of a decade, probably it's worth it. I do worry that this is going to be a little bit more of a death knell for yellow cabs, though, because people were seeking them out because they were so much cheaper. So they were significantly cheaper than Uber and Lyft, and now they won't be anymore. So people are more likely to revert to the apps.
I'm not a trend person, but I like just hailing a cab. It's super easy. If you're in like Manhattan, which I realize is only one small, tiny place. One big, small, I don't know. Anyway, I like hailing cabs.
As someone who's lived in Manhattan for 25 years, I can tell you that it has never been harder to hail a cab.
Every time I've been in, fine, I don't want to argue about this.
But you can, no, Emily lives a charmed existence.
I don't know.
And you can hail cabs.
Times I've been able to hail cabs, no problem. And I prefer it to like taking out my phone outside on the sidewalk and like fiddling around. It's so much easier to just like wave your hand at someone.
What's your number?
My number is 60,000. That is the approximate number of train conductors and engineers who are voting as to whether or not to ratify a labor contract that was hammered out a few months ago by the Biden administration. Remember when we talked about a rail strike a while back? It still could happen. And on Monday, we'll learn if these 60,000 conductors and engineers voted in favor of this contract or not. And even if it's not, then the prospect of a strike is back on the table.
So voting no doesn't mean you're voting for a strike, but it kind of makes a strike more likely?
Yeah, so you vote no, and then usually you agree to some kind of like quiet period where you promise not to strike, and then that quiet period ends, and then you can go out on strike. It doesn't mean you're going to, but you can.
And this is just a single sort of overarching vote with all 60,000 members, and they all get the same equal vote, and it's all like if whatever the majority chooses is what ends up happening.
Oh no, it's really bananas because there are about 100,000 of these railroad workers, and they're in 12 different unions, which is crazy. Already 3 unions have voted no, but the 2 unions announcing their votes on Monday represent more than half of all the workers. So it'd be 2 votes announced. So they'd have to vote yes in a majority of each of the votes.
And then if those 2 unions that represent the majority of the workers vote yes, does that decrease the chances that like the 3 unions that voted no will wind up going on strike.
Yeah, I think so.
Got it.
Yes. Because there are
Thank
not
you.
that many workers. You're welcome.
Thank you, Emily Peck, official labor market correspondent of both Axios and Slate Money. That was very informative and helpful. So we have a Slate Plus coming up on Elon-y things and Twitter-y things. Thank you very much to Anna Phillips for producing. Thank you for emailing us on slatemoney@slate.com. And we will be back next week with a fantastic Slate Money with our very favorite guest. All about money and class. All coming up. Tune in then.
This message is brought to you by Discover. Did you know you could reduce the number of unwanted calls and emails with online privacy protection, the latest innovation from Discover? Discover will help regularly remove your personal info, like your name and address, from 10 popular people search websites that could sell your data. And they'll do it for free. Activate in the Discover app. See terms and learn more at discover.com/online privacy protection.